QuickBooks Online 2021 Sales Receipt Payment Received at Point of Sale. Let's get into it with Intuit's QuickBooks Online 2021. Here we are in our Get Great Guitars practice file where we're going to be entering some sales receipts. Before we do so, let's open up our financials, balance sheet, income statement, and trial balance. So we're going to duplicate some tabs up top, right-clicking on the tab, duplicate it. Going to do it again, right-click on the tab, duplicate. One more time, right-click on the tab and duplicate. Let's then go down to the reports on the left-hand side. We're going to be opening up the trial balance by typing into the little find search thing here, the trial balance, and there it is. That's the one. Let's do a range change up top. Range change ending at 12/31/21 and run that report. I'm going to close up the hamburger, hold down Control, scroll up just a bit to that 125, go to the second to end tab, back on down to the reports on the left-hand side. This time we're going to be opening up the P&L, profit and loss, the income statement. Close up the hamburger up top, range change it, ending at 12/31/21, and run that report. So there's our income statement, and let's do the next tab on over for the balance sheet. Go into the reports on down on the left-hand side. We're going to be opening up our favorite report, that being the balance sheet report. And we'll click on that because that's how we open it. Click on it. And then close up the hamburger, range change it, ending at the 12/31/21 and run that report. So now we're going to enter a sales receipt. I'm going to take a quick look at the desktop version, not because you need the desktop version, but because we just want to look at the flow chart and it has one. So let's go on over to it. We're in our sales cycle. Last time we took a look at basically invoices and then the receive payment. We have not yet made a deposit for them. We'll talk about that later. But we want to now think about the create sales receipt. You could think about these as the items you would have, like if you're in the front of a cash register or something like that, where someone pays you at the same point in time. In our case, we're imagining someone like bringing a guitar to the cash register and they're going to pay for it like at that point. And then we'll ring it up and we'll get paid at the same point in time as opposed to billing and then getting paid. Now, as we get paid at the same point in time, we have the same kind of issue in that, do we want to put that payment directly into our checking account, or do we want to put the payment into undeposited funds and then transfer it to the checking account? It's more likely if you're actually in a store that you're going to want to put it into undeposited funds so that you can compile the payments that you have and then take them to the bank at the end of the day. When they go into the bank, all the cash payments that you received are going to be deposited together most likely, and therefore you want to make sure that you group them in the same order in the bank as they are in your books so that you can do the bank reconciliation. So it's probably, maybe even more likely that you use the undeposited funds. However, if you get paid like by check or payment by payment, and you just electronically put that into the banking account, then, and you do it one at a time, one payment at a time, then you may not need the added step of then going to the bank and depositing them and therefore going through the undeposited funds account. So we're going to go back on over, and what's going to happen when we do this, it's going to be similar to an invoice, except that instead of having accounts receivable go up, we're going to get some form of cash payment or not necessarily cash, but some kind of payment. So therefore, instead of accounts receivable going up, we're going to say like cash would go up, but we're not going to put it directly into the checking account, but instead into undeposited funds, where we will then deposit them at a later time when we go to the bank. The other side then is going to go to the income statement. So if I jump on over to the income statement, if we sell inventory, it's going to be included in the sales of the product line item, but it will only go up by the sales amount, not including the sales tax. The sales tax will then go back to the balance sheet, be on a payable down here. It's going to be on a payable to us going to the Department of California sales tax. And then we have the accounts receivable, the inventory also going down. So we expect to see inventory going down. We expect the other side then going to back to the income statement, the cost of goods sold. Then if we go back to the balance sheet, we also note that the subledger, since we're tracking a perpetual inventory system, will also be tracking the decrease in the inventory here as well. Let's check it out. Let's go to the first tab to actually do it. First tab, drop down in the plus button, customer section. We're not doing an invoice this time. We're doing a sales receipt. We're imagining we're at like a cash register. We got paid at the same time. Someone brought a guitar up to the desk where our cash register QuickBooks thing is at, and we said sales receipt. We're going to record it. We're going to open that up. We're going to say the customer string music, which I'm just making up, string music. And I'm going to add that as we go. So we're adding string music as we go because this is a new customer. And so there we have it. I'm just going to do a quick add. I'm not going to put the email address. Obviously, if it was a customer, we would probably want as much data as possible, depending on the type of industry we are in, so that we can send them our newsletter and, you know, all the good stuff we're doing, how we're saving the world in our own special way. And then we're going to say tab, and then this is going to be the number that's going to then populate automatically, location, tags, and then we're down to the payment. I'm going to say cash payment. This is the payment type. Could be a check, could be a credit card, and so on. We're going to say cash because we're imagining we're going to be compiling the cash, and then we're going to deposit it along with the other cash payments we got with the received payment ones in the bank. So then we're going to have the checking account. Now we could deposit it directly into the checking account, or we might use then, once again, the undeposited funds. And that's what we're going to do here. We're going to put it through undeposited funds, then take them out of undeposited funds, putting them into the bank in the same grouping as they will be seen on the bank statement. Then we'll go down to the product. We're going to sell an Epiphone semi-hollow body. So if I hit the drop down, the code for that is an EPSH. Epiphone semi-hollow body. There's the description populating for us. And so it's going to be, we had one of those, $400. Sales tax, I should be automatically applying, but I'm going to check it off here. We want the sales tax to be applied out. And then down below, I'm going to calculate the math just to be a straight 5% again. So I'm going to change the math down here on our sales tax. So it's not like a California specific, but like generic. Override it. I'm going to simply override it and say I just want a 5% rate. Just so we just have a generic sales tax at 5%, $20. Why? Because other, and then confirm and close. So there we have it. What's going to happen when we record this? It's going to be increasing because it's a sales receipt, some kind of cash account, but it's not going to go into the checking account. Rather, instead, it's going to go into undeposited funds. And that's going to be for the full amount of the 420. The other side's going to go to income on the income statement, but it's only going to be for the 400. The difference between those two being the tax, sales tax, which is charged by the government and therefore never hits kind of the income statement because we're just the collection agency that they made us collect it for them. So we're going to increase then the liability on the balance sheet for that. And then also inventory is going to go down by some amount that's not in here, but because it's a perpetual inventory system and the system knows what the cost of goods sold or the cost is from the inventory item, the inventory is going to be decreased, and we know that the cost of goods sold, the expense related to us consuming the inventory, is going to then be going up, as well as the subledger for inventory being affected as well for the units of inventory on a perpetual inventory system. Let's check it out, see if we're right on that, see if that is actually what does happen. So then let's go back to the balance sheet and let's freshen this report up so we're working with fresh stuff. And then if we go down, we're going to say undeposited funds should have gone up. If I go into undeposited funds, we then have our sales receipt now. There's our sales receipt string music. That was for the amount of the 420. That's the full amount of the invoice, including the sales tax. Going back to the balance sheet, the other side basically on the income statement. I'm going to the next tab over, income statement. Let's make a fresh report here, run that report. This one looks a little old. I could smell it getting old. We're going to then go down to the sales, and here it is. We're going to say that this one was the sales receipt. So this one was for the 400 now. So that's our sales amount, not including the sales tax that was included in on it. So there it is, the 400. Scrolling back up, the difference between those two is going to be the sales tax. And I'm going to go back to my report before I go find the sales tax. So we have the income statement, and then I'm going to go back to the balance sheet, and that's where the sales tax is going to be. It's going to be here in the California Department of Tax, because that's who we pay. It's a liability. I won't go into it now because it's going to be broken out a little bit funny, but it's in there. Trust me, it's in there. And then the inventory is going to go down, so inventory up top should be going down. Let's check that out. Inventory is going down for the sales receipt, which is this one. And there's the 320 that it's going down by. That 320, if I click on the 320, is not actually on the invoice. but the invoice knows that it should be decreasing by the 320 because it's driven by the inventory item. It knows by the inventory item. Scrolling back up and going to go back to then our balance sheet. The other side is going to be on the income statement, next tab over, and that's going to be in cost of goods sold. Cost of goods sold. And if I go then to the sales receipt, there's the other side of that 320. That looks good. Scrolling back up, going back then to our profit and loss. We also note, if I go back to the first tab, that the inventory account will be affected as well with our perpetual inventory system for the inventory reports. Let's open another tab to check those out. I'm going to right click on the tab far right, duplicating that tab. Going down to the reports on the left-hand side, and I'm just going to type in inventory because we're looking for inventory reports. So I'm just going to type in inventory, and we want the inventory valuation summary. Inventory valuation summary as of 12/31/21. Run it, close the hamburger, and so there we have it. And I think we sold, it was an EPSH, so this one we have no more of those. They're gone. They're totally gone. And we're now at the 27,932. If I go back to the balance sheet, we see the 27,932 there as well. Now we're going to do another one, but this time we're going to consider it not having an inventory item. Like, what if we sell something that's just a service item? Once again, at the same point in time that we get paid, it's going to be a little bit easier because usually we don't have sales tax involved, and obviously we don't have to track the perpetual inventory system in that case. In that case, undeposited funds would be going up again, other side going to income. In essence, that's it. So let's check that out. Let's go back to the first tab, do that one. It's going to be easy after the inventory one, and we'll hit the plus button. We're going to go down here to the sales receipt, and new customer. I don't think we have this one. His name is, they're called Sam the Guitar Man. Sam the Guitar Man. But that's not how you spell guitar. Sam the Guitar Man. And I did that on purpose so you can see that the customer line does indeed pick up the spell check in there, like when you're typing it. So then I'm going to say tab. I'm going to add it. We're going to say save that. Tabbing down, and the 16th, we'll keep that. Inventory, that looks good. And then they're going to sell, so we're going to sell some of our product, our services now. So one's going to be a diagnostic. So I'm going to make a diagnostic, which I'm not exactly sure what that is because it sounds more like a car thing, but you know, it's a acoustic or guitar diagnostic. And we're going to have 10 of those. 10 of those. Now the point here is just that when you're grouping things together and you have service items, it would be a lot easier. You could just have hourly rates, but if you can group your service item into bundles, like a diagnostic or something, whatever that would be for a guitar. But if you're like a lawyer, or if you're going to be a bookkeeper, if you can group your information together, like this is my grouped bookkeeping service for this range of basically transactions, because you can basically judge how large a customer is by the range of transactions, for example, then it becomes, your billing will be easier. So I highly recommend thinking about that and seeing whether or not you can do that kind of thing. And so then we have, I'm going to say hourly service 1. So hourly service 1. So we're going to say that's some kind of package bundle thing that we have here. And that's going to be for how many of those? 15 of those, we're going to say. And then we had tuning support. Tuning support, which again sounds kind of like an automobile unless it's tuning a guitar. And I don't think it's spelled right, but that's okay. Sorry about that. And this is going to be quantity 12 and the 200 at the rate. So now we've got the 680, the 2001, and the 2004 for a total of the 5,180. 5,180. So no sales tax is going to be applicable because oftentimes there's not for the service items. So what's this going to do? It's going to increase undeposited funds because it's a sales receipt. So we got some kind of payment. In this case, we're going to say the payment was cash. I'm going to say again, which is a lot of cash, but I'm going to say cash. And it's going into undeposited funds. So we're going to put it into undeposited funds again. And then the other side is going to go to sales. It's going to be driven by these inventory items. And we're going to put them to like a service item as opposed to the same account for the sale of the products or the inventory. So we're going to then say save it and close it. And we'll take a look at it. save it, close it. Back to then the balance sheet. We're going to go back up and run the report to make it fresh. And then go down to the undeposited funds. And in undeposited funds, we've got the 5,180. So there it is. Notice the split down here is because it's got those multiple line items in it instead of just one line item. And then if I go back up top, back to our report, and we go to the income side of things, we're going to go to the income statement. I'm going to make this report fresh, throw it in the microwave, warm it up. And then this is a service item, so we want that one. And then notice in here, it put it in here by 3 separate items with the same invoice number of the 1004. So it put it in there by line item because it's possible that the separate line items, you know, are going to another income account or something like that. But if I go into it, any one of these, it'll take us to, of course, that same sales receipt, which has all 3 of those line items on it. So there it is, all 3 line items then on that one sales receipt. Closing this back out, scrolling back up, back then to the income statement. If we then go to the trial balance, we could see this information a lot easier. So if I was to run this report and you were to check this same information out on the trial balance, you can do it with one report. So for example, that first sales receipt, we can see, okay, the undeposited funds went up, and then on the income statement side, which is down here, the sales went up, and then the difference between the two went to this account, which is going to be the sales tax payable in essence. We also know that the inventory went down, which is on the balance sheet in the assets section. And we know that the cost of goods sold was the other side that was impacted. This thing is in order, of course, by balance sheet on top of the income statement, which in turn will be assets, liabilities, equity on top of the income statement, revenue, and expense type of accounts. We can also see that this inventory item here, this 27,932, should tie out to our inventory report on the right. If we refresh this report, we now are at that 27,932. That shouldn't have changed because we didn't sell any inventory. So if we go back to this tab, then this is where we are at this time. So you can check your numbers each time. I'll try to print these out after each section so we have that for the checking of the numbers.